Unfortunately, yet again, a major retailer is reporting that the consumer is slowing down. This time it's Amazon making the report. So let's jump in and stay to the end because I'm going to share what this means to all of us. But first, let's see what's going on. Okay, according to CNBC, Amazon shares tumbled after third quarter outlook disappoints. And it says that the company is navigating slower sales in its core retail business and said that the chaotic news cycle was partly to blame. Now, I don't know about that. Amazon is a big company. They also offer a lot of tech services such as Amazon Web Services. That's doing well, but what we care about, we're looking at this as kind of an indicator to the consumer what's happening. So the article goes on to say the company set aside softer than anticipated sales because consumers continued to trade down to lower ticket items such as everyday essentials and consumables. So think about that. Think about the things that we all buy on Amazon, right? Amazon, you can buy almost anything on Amazon. And people are saying, you know what, I'm trading away from the wants, the cardboard boxes that were showing up at our house a couple times a week, and I'm focusing on my needs. I'm focusing on things I need to run my household, some grocery things like that. And the wants are becoming more optional, and people are buying wants less often and are focusing more on the needs. So what does that tell you? It says the consumer is getting tight, right? We've seen that unemployment has risen, unfortunately. And so the consumer is starting to feel squeezed. And that was really the goal of the Federal Reserve when they started raising interest rates, was to get all of us to start slowing down our spending. But the issue is we want a soft landing. We don't want a hard landing, and we want the economy to slow down, but we don't want it to slow down so much that it triggers a recession. It feels like we're getting closer to that. Let's keep going with this CNBC article. They talk about Amazon Web Services as well positioned, but and they talk a little bit about AI, but again, we care about the consumer. So let's switch over to a Reuters article now titled, Amazon says the consumer's cautious and they forecast revenue below Wall Street targets. Okay, Amazon's chief financial officer, their CFO, Brian Olszewski, told reporters on a call that consumers are continuing to be cautious with their spending trading down. He added that they're looking for deals and noted that lower priced products were selling briskly. So it's kind of the dollar store concept, right? When we all have less money in our pockets, we tend to buy the things that are less expensive. We're trading down. I know for me, my box of Raisin Bran that before the pandemic was $3, now it's $6. So I've traded down to the store brand, and I have to say, I don't miss it. I don't miss the brand name. This same Reuters article goes on to say on Wednesday, Kraft, the company that's famous for its cheese, and Oscar Mayer, Kraft said it had to begin offering many more entry-level points and expand its range of Oscar Mayer products at dollar stores and introduce Capri Sun multi-serve bottles because more shoppers were seeking value. Let's get to what this means for all of us. So, is the U.S. heading into a recession is the question we all have. And you know what? There's not many guarantees in life, but one of the things I can say is, yes, the U.S. is heading into a recession. Now, what I don't know is that in 3 weeks? Is it in 3 months? Is it in 3 years? Or is it in 30 years? But trees don't grow to the moon, right? We've had a very good run of economic growth, which is why the Federal Reserve started raising interest rates to slow things down. So eventually we will come into a recession. I want to point out this study, or it's really a theory. It's the SAM rule, S-A-H-M, the SAM rule, and it says anytime unemployment starts going up by a certain amount, it means that we're either in a recession or we've recently been in a recession. And I want you to look at this chart from the Federal Reserve. It goes all the way back to 1960. And those gray vertical lines, those are recessions. And you can see the percentage points that unemployment has gone up. So you can see here recession, and then you can see the blips, the spikes in unemployment. And you can see where, 2020 was the biggest one. And you can see as we're going on, this is updated live by the Federal Reserve, as we're going on now, that rate is starting to increase. I said earlier, the U.S. government is releasing that unemployment is going up, unfortunately, and this time it's impacting different people, and every recession is unique. But what's important, so while every recession is unique, what I don't think is unique is what we should do as investors. And as investors, the vast majority of us are not going to be able to time the market. It's an adage that's proven. I would argue even the professionals are not able to time the market. You might find somebody that calls a recession once or twice, or calls a big market crash, right? That's what we're worried about, is the market crash, the pain that it causes when our stocks go down. And the reality is most of us need to have some stocks in our portfolio so that we can get our money working harder for us than we work to initially put that money into our accounts. But it's a feature of the stock market, not a bug, that the stock market does have times where it goes down. So what do we do, right? And before I jump into what we do, I want to use an adage that I've heard that's helpful for me. And that is that the stock market takes the escalator up, or you could say it takes the stairs up, and it takes the elevator down. And what that means is the stock market falls much more quickly than it rises. So what should we do? I think we need to have a long-term asset allocation that's right for us for where we are now. If you're 30 or 40 years away from being retired, that's a very different allocation than if you're 3 or 4 years away. Now, some people would argue, and rightfully so, hey, Azul, even once I retire, hopefully I have a 30-year time horizon. And you do. But one of the things that changes, and this is a key point for this video, is the pain of seeing the stock market go down increases dramatically once the money we have in our savings account is all the money we're ever going to have. We're not putting new money in. When we're putting new money in, the stock market going down can actually feel like an opportunity for us, right? We can dollar cost average in. We can buy stocks, indexes, whatever, that have fallen in price because we've got time on our side, and because the pain, we're not fearful. We're not suffering from angst because the market has gone down. So we have confidence because we have a lot of time and because we're putting new money into the market. But once you retire, two things happen. The emotional aspects of the pain of the market going down increases dramatically. And in fact, for many people, it goes from a little bit of worrying to what I call angst. They can't sleep at night. It's constantly top of mind. They can't get it out of their mind that, maybe you've saved $800,000 for retirement. And if your portfolio drops 25%, you've just lost $200,000. And it's just human nature to think, how long did it take you to initially save that first $200,000? For many of us, it's a decade or more it took of saving and sacrificing. And now we're starting to take money out. So we become for our living expenses once we're retired. So we become a forced seller in a down market. So getting your asset allocation right. What percent of your portfolios in stocks? What percent of your portfolios in bonds? And maybe even cash. Maybe it makes sense. A young person should have, I think, 3 to 6 months of living expenses in case they unexpectedly lose their job in cash at the local bank. And maybe if you're in retirement, you should have a year or two of cash so you don't become a forced seller in a down market. If a video like this has been helpful, it's really about making good decisions. And that's why I made this video up here, which talks about why retiring at 65 might be a big mistake. I'll see you in there.